In today's economy, low interest rates are often praised for helping businesses grow and stimulating investment. The logic seems simple. Cheaper borrowing means more expansion, more jobs, and more benefits for everyone. However, while these low rates do fuel corporate growth and profits, the benefits rarely trickle down to the working class. Instead of higher wages, job security, and improved quality of life, many workers continue to face stagnant pay and economic insecurity. So, who truly benefits from low interest rates? And why does the average worker often miss out on the supposed economic advantages? Let's dive into the real impact of these financial policies. For large corporations, low interest rates are a powerful tool for growth. With cheap borrowing available, companies can take out loans to expand operations, invest in new technologies, or acquire competitors. This process is seen as a win-win. Corporations grow, jobs are created, and the economy thrives. But there's a catch. Instead of using borrowed capital to improve worker conditions, most corporations funnel it into projects designed to maximize profits and satisfy investors. One of the most common strategies is stock buybacks, where companies use borrowed funds to buy back shares, inflating stock prices and benefiting shareholders, including executives who often have compensation tied to stock performance. Unfortunately, workers rarely see these financial gains reflected in their wages or job security. While corporate profits surge in a low-interest rate environment, the working class often feels little relief. Despite the growth in corporate earnings, wages for the average employee have remained stagnant, unable to keep pace with inflation. The reason for this stagnation lies in the priorities of corporate leaders, who often view wage increases as unnecessary expenses rather than investments in their workforce. With a focus on maintaining low labor costs to boost profitability, companies choose to maximize profit margins rather than share the wealth with employees. This results in a growing disparity between record corporate earnings and workers' paychecks. The situation is further compounded by the increasing reliance on part-time, contract, or temporary labor. While low interest rates may lead to rapid expansion, these new jobs are often short-term or precarious, leaving workers without benefits like healthcare, retirement plans, or job stability. With the constant pressure to minimize costs, corporations are more inclined to offer flexible, less secure work arrangements rather than providing full-time, permanent positions that would offer greater stability and benefits. This shift toward part-time and temporary work means that many employees are left with no job security and fewer protections in the workplace, creating a volatile environment where layoffs can happen at any time. Another side effect of low interest rates is the rising cost of living. While corporate profits increase and asset prices like real estate rise, wages for the working class remain stagnant, leading to a significant gap in purchasing power. For example, with low mortgage rates, investors and wealthier individuals can buy property at a lower cost, driving up housing prices. As a result, renters and first-time buyers face an uphill battle in securing affordable housing. At the same time, everyday expenses like groceries and transportation are becoming more expensive. While corporate profits soar, workers struggle to keep up with rising living costs, making it harder for them to save or improve their financial security. Corporations that rely heavily on debt for expansion often face volatility and job insecurity. During times of economic downturn, these companies may find themselves unable to service their debt, forcing them to make difficult decisions such as layoffs or halting hiring altogether. This can leave workers vulnerable, as they realize that jobs created during periods of rapid growth are often the first to be cut when times get tough. Additionally, companies may shift towards more temporary or contract-based roles in order to remain flexible and reduce costs, leaving workers with fewer long-term job opportunities and little security in their positions. Despite the advantages of low interest rates for corporations, these benefits primarily flow to executives, investors, and shareholders, rather than to the workers who contribute to the company's success. For example, executive compensation is often tied to stock performance, meaning that as stock prices rise due to buybacks funded by cheap debt, executives can personally benefit from bonuses and stock options. Meanwhile, workers see little improvement in their pay or working conditions. This perpetuates the cycle of wealth concentration, where the wealthy gain even more wealth, while the working class struggles with rising living costs and stagnant wages. One of the most glaring disparities in the low interest rate economy is the disconnect between corporate borrowing and real benefits for employees. While companies may grow and profits may increase, the benefits for workers are often limited or non-existent. This is because, in a debt-driven economy, corporate leaders are incentivized to pursue short-term profits at the expense of long-term investments in their workforce. With borrowing costs low, companies are under pressure to generate quick returns to service their debt, leaving little room for wage increases, improved benefits, or better working conditions for employees. So, what could be done to create a more equitable economy? One potential solution lies in shifting towards an ownership-based model, where corporate growth is tied to real assets and profits rather than debt. In such a model, companies would rely on actual profits to fund their expansions, rather than borrowing money at low rates. This would encourage more sustainable growth, with companies investing in their workforce and local communities rather than focusing on stock buybacks and short-term returns. An ownership-based system would reduce the pressure to prioritize shareholders over employees, enabling companies to reinvest profits into higher wages, better benefits, and long-term job security for workers. With an ownership-based model, companies would also have to operate more transparently, as their growth would depend on tangible, real-world results. This increased transparency would allow workers, investors, and stakeholders to better understand how resources are allocated and how profits are being used. This would encourage greater accountability from corporate leaders, leading to more responsible business practices and a focus on long-term sustainability rather than short-term financial maneuvers. An ownership-based economy would also shift the focus from speculative growth to real value creation. Instead of borrowing to fund risky ventures or pursuing short-term profit targets, companies would be incentivized to create value that benefits not only shareholders, but also workers, customers, and communities. By investing in the workforce, improving working conditions, and providing fair wages, companies would be able to build long-term relationships with employees, creating a more stable and secure workforce. In conclusion, low interest rates have been a boon for corporations, providing cheap access to capital and fueling rapid growth. However, the benefits of this system rarely reach the working class, leaving many workers with stagnant wages, job insecurity, and rising living costs. A shift to an ownership-based economy could address these issues by focusing on sustainable growth, long-term stability, and a fair distribution of profits. By prioritizing employee investment and transparency, companies could create a more equitable and accountable economic system that benefits everyone, not just executives and shareholders. As we move forward, it's essential to rethink how corporate growth and wealth are distributed, ensuring that prosperity is shared and that workers are recognized as the true drivers of success. Let's work together to build a more inclusive and sustainable future.